Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Micron Technology.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
So to set the stage for today, I want you, the listener, to just imagine for a second that you just spent billions of dollars, like literal billions.
Which, isn't hard for these tech giants right now.
Right, exactly. So you spend all this money to hire the absolute fastest, most brilliant team of researchers on the planet, and you put them all in a massive stadium to solve your hardest, most complex problems.
Sounds like a great plan so far.
It does, right. But there is a fatal catch. Your brilliant thinkers, they have almost no short-term memory.
Oh, wow. Okay.
Yeah, and the only way they can receive the massive amounts of data they need to actually do their work is through a single regular-sized door at the front of the stadium.
That's a massive bottleneck.
Exactly. Doesn't matter how fast those processors are inside. I mean, those thinkers, if they're waiting in a bottlenecked line at that single door, they're sitting idle. Your billions of dollars are effectively wasted.
And that is the exact physical problem the technology sector is currently facing with artificial intelligence.
Right. It's a hardware issue.
It is. And today, we're looking at the company that is basically tearing down that single door and building a massive, specialized data highway in its place.
Micron.
Yeah, Micron. We've pulled together recent earnings reports, flow data from Vanda Research, Wall Street analyst notes, all of it. And they are experiencing a staggering, unprecedented revenue inflection right now.
Driven by AI, obviously.
Almost entirely by the AI memory supercycle. I mean, this is not just some minor earnings beat. This is a company being completely transformed by macro demand.
All right, let's move into the wealth building context. Because if you're sitting at home watching a company experience that kind of massive inflection, your immediate instinct is often to try and, de-trade the momentum.
Oh, absolutely. The FOMO kicks in.
Right. You see a stock chart rocketing upward and you think about making a quick flip. But if we're looking at this through the lens of long-term wealth creation, we have to understand the underlying structural shift in the business itself.
Exactly. And the core shift here is profound. Like, historically, Micron has been viewed as this traditional, highly cyclical commodity supplier.
Boom and bust.
Total roller coaster. You bought the stock when memory chips were cheap to produce, and you sold when there was a supply glut. It was honestly stressful to hold.
Yeah.
But what we're seeing right now is Micron transforming into a contracted foundational infrastructure partner for the AI revolution.
I really want to explore that commodity aspect, actually, because it frames the mindset shift you need to understand this play. For decades, legacy memory chips were essentially the crude oil of the tech sector.
That's a really good way to put it. Just a raw commodity.
Exactly. Raw, interchangeable. When demand for PCs or smartphones spiked, the price of that quote-unquote oil surged. The memory companies made a fortune, and then
They overproduced.
They always overproduced. The boom always led to a bust. So what you're describing now, this shift to multi-year contracts with massive tech companies, it makes me wonder, is Micron evolving from a wildcatter constantly drilling for boom and bust oil into something more like a highly predictable public utility for data?
Oh, absolutely.
Because does that utility model set the foundation for a multi-year investment horizon?
It absolutely does. And honestly, the utility analogy is the perfect way to look at it.
Yeah.
If you're a utility company providing power to a major city, you don't wake up in a cold sweat wondering if people are going to turn on their lights next month.
Right. You just know they will.
Yeah, you have agreements in place. You have deep infrastructure integration. I mean, Micron recently signed its first ever 5-year contract for memory processor.
5 years in memory.
Yeah. That level of long-term revenue visibility used to be considered impossible in this space. When you transition from just hoping people buy your chips on the open market to having ironclad multi-year commitments from the biggest tech companies on Earth, it fundamentally changes the entire wealth building equation.
Now let's look at the fundamentals, because I'm looking at the math behind this transition. To be honest, it's almost difficult to process.
The fiscal second quarter of 2026 numbers are just staggering. Let's just look at the top line first. Revenue was up 196% year over year.
Wow.
Yeah, up to $23.86 billion. They effectively tripled their revenue. But the profitability is where the real story lives.
Okay, let's hear it.
Net income went up 772%.
Wait, 772%?
Yep, to $13.79 billion. And on a non-GAAP basis, meaning when you adjust for one-time costs to see the core health of the business earnings per share, spiked 682% to $12.20.
That is absurd.
It gets better. The metric that truly proves they're moving away from being a mere commodity is their gross margin. Non-GAAP gross margins hit 75% in the recent quarter.
Okay, I have to stop you right there. Let's puzzle this out for a second. A 75% gross margin on a physical piece of hardware is incredibly rare.
Very rare.
If you look at the market, you usually only see those kinds of margins in like high-end software as a service. Software gets 75% margins because once you write the code, copying it is essentially free.
Right, the marginal cost is zero.
Exactly. But Micron is a physical manufacturer. They are buying raw materials, running factories, shipping physical silicon. How is a physical manufacturer pulling off a 75% margin without competitors instantly undercutting them to steal that profit?
That's a great question, and it really comes down to their oligopoly mode. Yeah. Back in the 1990s, there were dozens of companies making memory chips.
And they all just price warred each other to death.
Exactly. They undercut each other until most of them went bankrupt. Today, the global DRAM market is completely dominated by just 3 players: Micron, Samsung, and SK Hynix.
That's it. Just the 3.
That's it. Together, they control more than 90% of the world's production. That market structure severely limits the risk of irrational price wars. You simply cannot just spin up a startup and compete with them.
The barriers to entry are just too high.
Way too high. And right now, 65% of Micron's revenue is coming from hyperscalers, those massive cloud computing giants like Amazon, Google, Meta, and Microsoft.
On those multi-year contracts.
Exactly. So their moat isn't just intellectual property anymore. It's these deeply integrated, high switching cost relationships. As their CEO put it, AI has fundamentally recast memory as a defining strategic asset.
Let me put on my risk-aware hat for a moment, though, because his numbers are fantastic. But building the physical hardware for this supercycle is extraordinarily expensive.
It's not cheap.
Not at all. I'm looking at their capital expenditure guidance. Management has raised their CapEx to exceed $25 billion for fiscal 2026.
Yep.
And they are projecting an additional $10 million on top of that for fiscal 2027 just for construction spending, building new fabrication plants in Idaho and Taiwan. When I see a company dropping $35 billion over 2 years, my immediate concern is cash flow.
Which is fair.
How severely does that kind of outlay impact their free cash flow? Does it threaten the stability of the balance sheet? If you look at the broader tech sector right now, the average trailing price-to-earnings ratio is sitting around 43. Micron right now is trading at a trailing PE of about 27.
Which is wild when you think about their growth.
Yeah. Even with the heavy capex and the massive revenue spikes, it is significantly cheaper than the tech sector average. That suggests the current valuation is supported by actual fundamental cash generation, not just speculative froth.
That brings us to the catalyst timeline. Over the next 3 months, the calendar is packed with events that could further validate this thesis for you.
What's the biggest one coming up?
The immediate hurdle is the fiscal Q3 2026 earnings report in late June. The entire market is going to be dissecting that report line by line for any upside in high bandwidth memory revenue.
Right.
But the real driver here, the thing you need to focus on, is the macro tailwind. Wall Street is projecting AI infrastructure capital expenditure to hit somewhere between $750 billion and $1 trillion by 2027.
$1 trillion in infrastructure spending in a few years is just a tidal wave of capital. But before we get into the spending, let's back up to that term you just used, high bandwidth memory, or HBM.
Sure.
What exactly makes HBM so vital that it's commanding this kind of capital? Like, how does it actually work compared to the memory in my laptop?
Okay, think back to your stadium analogy from the beginning.
Right, the single door.
Standard memory is like that single door. It sends data to the processor one piece at a time, sequentially. High bandwidth memory changes the physical architecture. Instead of laying chips flat next to the processor, HBM physically stacks memory chips on top of each other, like floors in a skyscraper.
Oh, interesting.
And then it punches microscopic holes through them so data can flow vertically. It essentially builds thousands of doors directly into the processor.
So they aren't waiting in line anymore.
Exactly. It allows the processor to pull massive amounts of data simultaneously. And that simultaneous data processing is exactly what artificial intelligence models require to function.
So the hyperscalers, Alphabet, Amazon, Meta, Microsoft, they're aggressively raising their spending targets month after month to secure this specific type of stacked memory.
Yep, they need those thousands of doors.
Every time one of those giants announces an increase in their data center budget,
Yeah.
that is a direct, tangible catalyst for Micron.
Exactly. And we're also watching their product pipeline evolve to meet this. They just launched the 245 terabyte Micron 6600 ION solid-state drive.
245 terabyte.
Yeah. To put that in perspective, that is the world's highest capacity commercially available drive, and it is explicitly targeted at AI and hyperscale data centers. They are building the exact heavy-duty tools this trillion-dollar wave requires.
Let's examine the behavior of those hyperscalers for a moment, because there's an incredibly interesting speculative angle here. We've seen rumors floating around, for example, SK Hynix reportedly fielding offers from global tech firms to actually finance their ultraviolet lithography machines.
Which is unprecedented.
Totally. And for context, these lithography machines are the size of a city bus. They cost hundreds of millions of dollars, and they use extreme lasers to print microscopic memory circuits on silicon. There is real speculation that Micron could receive similar strategic prepayments or even joint venture investments from these hyperscalers just to secure manufacturing capacity.
Right.
Why are these massive tech giants so desperate for memory that they would essentially bankroll a supplier's factory equipment?
Because they're trapped by the physics of AI. You can buy the most advanced, expensive processing unit on the planet, but if the memory can't feed data to that processor fast enough, it just sits idle.
The bottleneck.
It's a physical bottleneck. Without high bandwidth memory, the billions of dollars these hyperscalers are spending on AI processors are effectively wasted. They're desperate because memory allocation is the single defining factor in whether they win or lose the AI arms race.
Now let's pivot to the chart. And this is where my caution really flares up and where you, the listener, really need to pay close attention. When we talk about technicals, we are looking at a stock that has experienced a violently parabolic breakout.
Oh, the price action has been historic. It just recorded its best week since December 2008.
Wow, 2008.
Yeah. The stock surged nearly 38% across a single week, including a massive 15% jump on May 8th alone. It hit all-time highs of $747.21.
And that specific number is what concerns me. It is currently trading over 700% above its 52-week low.
It's a huge move.
If you're looking at a chart that's up 700%, your immediate instinct is probably telling you that you missed the boat. A stock moving that fast off its lows usually spells overheated. The technical indicators show it trading wildly above its moving averages. And when I look at the flow data from Vanda Research, they noted that net retail buying hit a 2-year high in mid-April. Everyday investors are commanding a huge share of the flow right now, so we have to ask, is this incredible price structure just a symptom of massive retail FOMO? Are people just blindly chasing the hype?
Look, it is incredibly tempting to look at a 700% chart and dismiss it as a retail bubble. I get it. But you have to look deeper at the structural, institutional flow underpinning that price action.
It's not just retail.
Retail is participating, yes, but a big money is establishing permanent positions. Look at the Roundhill Memory ETF. That fund alone funneled $6.2 billion into the memory sector in just 30 days.
That's a lot of capital in a month.
It is. And here's how that works mechanically. When an ETF takes in money, it doesn't try to time the market. It is structurally mandated to buy the underlying stocks. When billions flow into a sector ETF, a massive percentage of that capital is forced automatically into core holdings like Micron, regardless of retail sentiment.
So it's forced buying.
Exactly. That creates a foundation of institutional passive buying pressure that simple retail FOMO cannot sustain on its own.
So what does market sentiment look like? We see the money moving mechanically, but what is the professional narrative surrounding this price action?
The analyst community is overwhelmingly bullish, and they're backing it up with aggressive targets. D.A. Davidson recently initiated coverage with a street-high price target of $1,000. $1,000. Mizuho reiterated their bullish stance, highlighting that Micron's leading-edge DRAM nodes, the microscopic generations of these chips, are driving significant cost reductions and capacity gains.
Right.
And both Bank of America and Bernstein have lifted their targets on memory stocks, pointing directly to sky-high average selling prices and demand that is vastly outpacing supply.
I want to highlight a specific piece of news sentiment from May 10th that I think captures the psychology of this market perfectly. The headline was simply, "Markets love chasing bottlenecks."
That's such a great headline.
It completely reframes how we should view this company. They are no longer just a semiconductor manufacturer making interchangeable parts. They have become the physical bottleneck of the entire global AI boom.
Yes, exactly.
If you want to build AI infrastructure, you have to go through them. That forces you to consider the immense pricing power they hold. If you have a line of hyperscalers out the door, all with bottomless budgets, fighting over a physically limited supply of high-bandwidth memory, you get to dictate the terms of the market.
Now let's talk about the risks. Because building wealth requires protecting the downside, and holding a stock up 700% in a year carries undeniable risk.
I am going to lay out the bear case heavily here because it is substantial and you need to hear it. First, we have to look at valuation risk.
Right.
Despite that relatively low PE ratio we discussed, some community fair value estimates like from Simply Wallace suggest the stock may actually be 47% overvalued at current prices near $746.
That's a big premium.
It is. But beyond the immediate math, we have to confront the historical ghost of memory investing, which is cyclicality and oversupply. Memory has always been a ruthless cycle. The bear case asks a very simple, very dangerous question.
Which is?
What happens if AI spending slows down? If these hyperscalers suddenly decide they have enough capacity, or if a macro recession forces them to cut their capital expenditures, doesn't the price of memory crash overnight, taking Micron 75% margins down with it?
It is the most valid concern an investor can have in this space. I mean, history says yes, but you have to look at the concrete mitigations that make this particular cycle fundamentally different than the crashes of the past.
Okay, lay them out.
Remember those multi-year contracts?
Right.
Micron's high-bandwidth memory allocation is completely sold out for the entirety of calendar year 2026.
Completely sold out.
Completely. The supply is already spoken for. The revenue is locked in legally.
But what about the $35 billion in new fabrication plants we just talked about? Doesn't the massive expansion in Idaho and Taiwan guarantee an eventual supply glut once those factories turn on?
Eventually, supply will catch up to demand. That is the fundamental nature of capitalism. But the physical reality of semiconductor manufacturing is that you cannot build a fab overnight.
True.
The massive, extreme ultraviolet lithography machines we talked about take months just to install and calibrate. The new facilities in Idaho and Taiwan will not meaningfully contribute to global supply until fiscal year 2028.
So it's years away.
The risk of a supply glut is years away. For the next 2 to 3 years, the market is structurally, physically constrained.
So with everything on the table, what's the final verdict?
The official ruling from the research yields a bullish score of 9 out of 10.
9 out of 10.
Yeah. The elevator pitch is clear. Micron Technology has successfully transitioned from a cyclical commodity supplier into the essential contracted infrastructure backbone of the AI supercycle.
They locked in the revenue.
They've locked in multi-year revenue visibility. They have completely sold out their premium capacity. And with fab construction constraints limiting new supply until 2028, combined with hyperscaler spending accelerating past $1 trillion, their pricing power is just unparalleled. They remain the most undervalued cornerstone of the AI build-out.
And bringing it back to our wealth building context, the target horizon here is a multi-year hold. This isn't a stock to try and flip on next week's momentum.
Definitely not.
If you think back to our earlier analogy, they are finalizing the transition from a boom-and-bust oil wildcatter into the highly profitable public utility powering the data age. The strategy for you, the investor, is to hold through the inevitable short-term volatility to capture the full economic duration of the 2027 and 2028 infrastructure supercycle.
Right out the bumps.
Exactly. But I want to leave you with one final provocative thought to chew on as you watch this space. If memory is the ultimate bottleneck today, what happens in 5 or 10 years when quantum computing matures and demands an entirely new alien architecture? Will today's incredibly profitable utilities become tomorrow's relics? It's something to keep in the back of your mind as this technological arms race evolves. Need emergency cash? MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.